Hi, Keith. Are you well?
Yes, thanks, Morris. How about you?
Yeah, so good afternoon, everyone. My name is Dr. Morris Mthombeni, faculty member at GIBS, and I'm going to be in conversation with a colleague and friend, Dr. Keith Fairhurst, also an associate and faculty member at GIBS, but more importantly, an accomplished turnaround specialist. So Keith, here we are. We've done our fair bit in terms of trying to kind of turn ourselves around. I see we're wearing a jacket and a shirt and a tie, something we haven't done for more than 8 weeks on my part. I don't know how long on your part. And I'm not going to stand up and show you, but I'm also wearing pants as opposed to short pant. So I'm really quite professional today. So we are joining in conversation today to talk about how companies can turn themselves around or can prepare for the gradual unlock starting tomorrow, the 1st of April, so that we can start recovering our economic activity. As a turnaround specialist, what are some of the advice that you might want to kind of kick us off with to help us to understand what organizations will be facing in the coming days and weeks?
Morris, thanks so much for that quick intro. And I think probably a point that you've made that you made now in the introduction, where you sort of tongue-in-cheek said you are wearing long pants and you're not faking it, is possibly what we're going to see when the economy starts to wind up again. So in South Africa, we have partial relaxation from the 1st of May tomorrow, and businesses are going to start operating. And these businesses are going to have to start dealing with what they see in the future. The problem is that the future is not what it used to be. So looking forward, it is unlikely that things are going to play out the way we experienced them playing out before lockdown occurred as a result of COVID-19. So the question is, what do we do with that? And I'm hoping that today we can share some thoughts that we and my colleagues in the turnaround world have learned from helping companies recover from financial distress.
But maybe we could start with some, how can I say, case study type of conversation in thinking about what distress means, the range of distress. For example, there is something that we saw recently with Edcon filing for voluntary business rescue. That's one kind of extreme of distress. And another may well be a business that was doing reasonably okay pre-COVID lockdown and now finds itself in a bit of strain and needs to kind of kickstart itself. So what does distress mean generally to people like yourselves?
Okay, so it's a continuum. It's not a point. So financial distress has got many features to it, but before it starts showing up very visibly, some of the symptoms may exist, and that would be things like underperformance, suboptimal returns. That's the early days. It's not, you can still pay your bills and you still have got enough cash and there's still solvency. But if that continues, the chances are that company may slide into worsening performance. Financial distress is officially defined as that point where you cannot meet your obligations in the forthcoming 6 months. That's a legal definition. But our experience has been that by the time that becomes visible, the company has been struggling for some time. They have perhaps had some cash flow challenges. They've had to extend their borrowings. They may have had to discount rapidly to try and get an injection of cash. They may have even had a rights issue and sold additional equity in the business in order to raise some capital. There's many numbers of ways, but it's a gradual declining. And some researchers have said that the signs are visible for as much as 5 years before the first default on payment occurs. Now, that's quite a long time. The message really that we like to give to people is take action early. And I'll give you two case studies. So, as you know, and I know we've got an audience that is beyond the South African borders, but these are South African examples. So in South Africa, we have a mechanism called Business Rescue, which is Chapter 6 of the Companies Act, which for those of you that know American situation, you might have heard of Chapter 11. It's a little bit similar. So Chapter 6 gives a company some protection from legal action and allows them to try and reorganize their affairs in order to restructure and reposition themselves and in a way reinvent the business to be sustainable. That's what's happened with Edcon. Edcon has taken that option. They have now legal protection and some sort of moratorium. Okay, but practically, what does that mean? Well, the message is that in the case studies we've seen, you need to do that sooner rather than later. And that's true for any action. I'll give you two specific examples that I've been involved with. In 2012, my business partner and I turned around an IT company who had a very responsible chief financial officer. This chief financial officer said to the CEO en route to see a major client, if we do not get this contract signed today, I'm phoning Keith because I want him to advise us on what to do about turning this business around because we will be in distress. 2 hours later, they walked out of their client's office. This is a very substantial business. Walked out of their client's office without the contract, and the client had given them the sad news that the project was going to be postponed for 1 year. From the car, that chief financial officer phoned me and said, Keith, this is what's happened. Please, can you come and see us and advise us? The next day, we were in their offices and we did a quicker snap assessment. And we said, guys, this business has got reasonable prospect. In other words, it is, in our opinion, got enough fundamentals present to be sustainable. But you have to take action immediately. The next day, they decided to apply for business rescue, which they did. I'm delighted to say that over a 2-year period, we paid back every single creditor 100 cents in the rand. So not one creditor lost their money. We had to restructure the business to suit the market they were targeting for. And we had to be patient for some of the bigger contracts. I'm delighted to say that that business today is profitable. The same shareholders are in place. They employ the same number of people very successfully. And most importantly, the creditors did not take a haircut. They got paid every single cent they were owed.
So let's stay with the good news, because as you know, I like being the agents of hope. And whilst I'm going to ask you to go deeper into that particular case study, Keith, I'd like to invite our viewers to please post questions on the chat throughout the discussion. We look forward to your your questions and engaging with your questions throughout. And we'll be very happy to engage with those. Keith, I know what you've just done now. You mentioned some big words like business rescue, and another one was reasonable prospects. So I wonder if you could just explain what you mean by the term reasonable prospects, and also maybe explain what you mean by business rescue, because I think if I'm not a lawyer and I'm not into this stuff, it sounds a bit like a very negative thing. Why do I need to be rescued? Is it a sign of failure? Just explain this tool of business rescue and this concept of reasonable prospects, please.
Okay, so let's talk about what people experience when they are faced with distress. They are often overwhelmed because there is so much pressure coming at them. They are being hounded left, right, and center by people chasing them for payment. And typically we sort of tongue in cheek say, you know, your receipt from your customers always comes later than the payment you have to make to your suppliers. So there's always this cash shortage, and that pressure is dramatic. And I don't think one must underestimate that pressure and the tension that brings to the decision makers. And the decision makers are so distracted by trying to just keep things going on a day-to-day basis, they find it difficult to step back and think about this business and say, okay, what do we need to do to put this business on a sound footing? Business rescue is a chapter of the Companies Act in South Africa that allows a company some breathing room. It allows the company to stop for a moment, and it suspends the legal challenges that the company may be facing, so that the management can, with the guidance of an appointed independent person, this is quite key. An independent party is in the form of a business rescue practitioner, is appointed to represent all the affected parties. That means the people that are likely to be exposed should this company have to close or be liquidated. So there's a legal definition for who they are. They're employees, creditors, shareholders, and for particular reasons, trade unions who represent the employees. So it's essentially those parties whose interests need to be looked after. So with that in mind, there's a moratorium. And there's three parts to business rescue. The first thing is the legal moratorium, so that creditors cannot take legal action against the company during the business rescue period. The second thing is that there's appointment of an independent person who will make decisions to represent those affected parties. And the third thing is that the independent person has to prepare a business rescue plan. It's a turnaround plan. And that turnaround plan is voted on by the people who are owed money. That's in a nutshell how it works.
So Keith, there's a question here that regarding your IT business case study that might help eliminate some of the points that we're talking about, and when we can move past this thing about definitional issues in a moment. The question is, in the absence of revenue or a major contract in your IT business case, may you kindly elaborate on what these other areas of business fundamentals are that enabled them to be able to pay the 100% to the rand, so to speak, and to turn around and become a good, sustainable business through the cycle?
Yeah. So I think that's captured in a question that we always ask, and I use the term reasonable prospect. So that's the legal term. Let's park that. What it really means is, do we have a business? Do we really have a business? So there's three things that we look at. Is we say, have we got a product or service that can be delivered by the company? That's the first question. The second question is, have we got customers? Is there a customer base? Is there a target? Do we know who we're going to trade with, who we're going to contract with, who we're going to sell to? And the third thing is, do we have operationally the ability to deliver the service or product? Those are the three first things. And obviously, there's a lot more detail behind each of them, but that's the starting point. You ask those three questions. If you have a business, then you can say, okay, the chances are we have reasonable prospect, and this company needs some breathing room and a bit of time. And the time will allow you to reorganize your affairs and perhaps pay people off over time, but achieve a successful outcome.
So if I use some of my experience, Keith, I see some people are really interested in raising the issue of SAA. We can come back to that in a moment. Is that what we're really dealing with, if you've got reasonable prospects, is that organizations don't have the immediate liquidity, the immediate cash to meet their immediate liabilities, right? So they may be asset rich, but liquidity poor. And therefore, if you have a business that, given the breathing space, can turn some of its assets into the required liquidity, you are then able, in an orderly fashion, to meet your obligations. And it then allows, whether it's your creditors in the form of your landlords or in the form of your suppliers, to kind of say, I'm not going to meet my requirements as per our original contract. We are then going to have to renegotiate the terms, the term over which we'll pay you and how much we'll pay you, with a view ultimately to get you as close as possible to what we owed you in the past. So it just creates a legal framework for that discussion to take place in an open and transparent manner, using turnaround specialists like business rescue practitioners as independent parties to facilitate that. Is that a nice way of also putting it together then, Keith?
Yeah, Morris, let me just reflect and go back to the question of the IT business case.
Yes.
And, you know, did we have, so the question there was, did we have a business? And I think what I heard in your question was, even though we didn't get the big contract, what did we do to survive? That's a simple term. Well, the interesting thing in that case is when we did the investigation, the company had been geared up for the landing of this big contract. So they had geared up resources, they'd take on extra office space, they had spent money, they'd made commitments, they'd employed people who were actually not working because they were employed for the contract. Well, when I say employed, they weren't employees, they were contractors in this instance. And so we had to make some hard decisions. So there were tough decisions to be made. And what we had to do is we had to deal with what we call the slack in the business. So because it was an IT services company, they didn't have a lot of hard fixed assets that were not revenue generating, but they did have expenses that they were incurring that were not value creating. Like they had extended their office space, they doubled their office space. So they had a big rent bill. So we negotiated with the landlord and we said to the landlord, look, we'll continue to, you can claim the rent, but we're asking you to try and find another tenant. The landlord, we want to go back to half the space. It was the same landlord. And we were very fortunate. They found another tenant so we could halve the rent. We also had to, when the contracts came to an end, we didn't renew them. So we reduced their monthly running costs. So essentially what we did is we trimmed the monthly costs down to fit the amount of business that they had at the time. And we then calculated how much free cash that would give us to pay for creditors. We reached an agreement with the creditors where we converted the debt to long-term non-interest bearing loans that would be paid off over a period of 2 years. Thankfully, and we did that on the, and we sized the business on the assumption that the big contract may still not come. So we didn't factor that in. Fortunately, after 18 months, that big contract did come in. It still didn't come in a year later, it came in 18 months later. But what we did is we right-sized the costs. So the first step is you have to stabilize the situation. And maybe this is a time for us to show the slide, Morris.
Sure, absolutely. So maybe whilst you're showing this slide, I'm going to ask you to, there are some really interesting questions that we're going to have to come back to that relate to the role of the business rescue practitioners and the fairness around why you should be paid first and so forth. So we'll come back to that. So what I would like you to do in showing this slide, Keith, is please help us to understand at a practical level some of the steps that you were talking about in terms of right sizing in respect of your client, and some of the practical steps that businesses can focus on in this regard.
Okay. And I want to contextualize it, Morris, in terms of COVID and lockdown. And if you can you see my slide now,
Yes,
Morris?
I can. Yeah.
Okay, so I'm assuming the audience can see it. So what I've done here is I've just put together a generic timeline, and I mean those timelines, days and years, are really very generic and could be. It's rare that it's less than this, but it could be as much as double this time. But it gives you an idea of the types of things. The first thing that happens is that we're dealing with a situation of crisis management, because the moment your creditors start hounding you for money, which outside of lockdown happens when businesses get into distress and is likely to be more prevalent now after lockdown, it's crisis management. And you got to deal with the crisis management. So what happens under crisis management, the first thing you got to do is you've got to assess the situation. And you've got to recognize and accept that there's a need for turnaround. We have seen far too many examples of people, management and shareholders, hoping that next week will be different to last week, but not doing anything differently, carrying on in exactly the same way and just hoping that miraculously things will change. Well, sadly, experience tells us they don't. So you've got to start by recognizing that there is a problem. Then there has to be a situation analysis. So that's where we say, do you have a business? So our situation analysis in terms of the IT company was to do an assessment of their revenue stream and their cost streams and their asset base. And then based on that, you can start making sensible choices about what is affordable, what can you get rid of to generate cash, how can you pay down debt? And that is what we call stabilization activity. Now, the stabilization activity, in the situation analysis, you will identify the constraints. Now, one of the constraints that you may have if you're a trading business is that your suppliers will only supply you if you pay them cash. So now you have to try and raise some short-term capital, some working capital. And that's where the asset base is quite important. If you've got...
If I can ask you to pause there for a second, Keith. So yeah. I've been actually observing businesses in the South African context, from what you can see in the media, and then in Europe and the US, for example. So what is interesting is that in the US and Europe, many of the businesses have to date already gone back to their shareholders to raise additional capital. So in terms of to do some kind of corporate action to raise additional cash for their businesses, which effectively means you invite new shareholders and you dilute existing shareholders and you issue more shares to get more cash in as a mechanism for doing that. So they're not even waiting to go to the bank, for example, or waiting to access the various rescue packages that are being offered by government. Why do you think South African businesses have not gone out and done more of that in a proactive manner to go and invite new shareholders, particularly to address some of the constraints and to enable the stabilization activity that is reflected here on your slide?
Morris, I think that's a very interesting question. And
thanks, Keith. That's why we are both doctors. We do these kind of things. We raise interesting questions.
And I can only share what I've seen in practice where I've been involved. I do not wish to speculate about matters that I don't have insight into. But what I have seen is that many companies, particularly if they're privately owned, are undercapitalized. So they fund the business with too much debt in relation to how much capital they put in. Now, that's not quite as prevalent with listed companies because they have a different level of visibility. But certainly with private companies, and as you know, that was part of my own research, that is the case. They're undercapitalized. And that then makes it logical to go to the shareholders and say to the shareholders, your debt to equity ratio is out of balance. You have got too much debt for your equity position. So therefore, if you need more cash, you need to consider raising it via equity. Now, as to why companies are not doing it in South Africa, where I have seen it is when they do it is because they've exhausted the debt avenues. They've been to the lenders already, and the lenders are starting to say, the risk is too great for us here. We're not prepared to advance more. You don't have assets to secure it. Your business is too heavily geared, and therefore we're not prepared to advance. So they then say, okay, well, we'll look at equity providers. That's been my experience, particularly with private companies. I don't know why they haven't taken advantage of government offers. I can tell you that companies that I'm involved with, where I advise the boards, they've gone to great lengths to understand what relief is available. And for instance, they have already where they've had to cut staff costs, they have already taken advantage of the UIF offering. So I don't have a ready answer for that. I think time will tell. But I can tell you that the ones that I'm working with have been trying to make use of the best they can and reaching out to the government support mechanisms.
Thanks, Keith. So I want to go to some of these questions that are on the screen here, and I see Lindo also might have been struggling to follow our discussions, which I don't know whether it's a function of the complexity of the topic or a reflection of the conversationalists, the presenters. Be that as it may, I want to go to them and ask them to come in, and possibly even trigger to them to think about what strategy might mean in this environment as we unlock, and what is a turnaround strategy, and ask them to think about that as well. So earlier, there were questions about who actually benefits from these turnarounds. And so one of the questions on the chat here was, in the SAA scenario, the business rescue is essentially a long road to liquidation. It feeds lawyers before closing down the business. Your thoughts on that?
I mean, you really are asking me to put my neck out here. And I'm going to choose my words very carefully. SAA has been propped up for I don't know how many years now, but more than one or two. The question then is, do we have a business? Do we have a business with a set of customers, with a service offering, and with the ability to service them at a profit? If that does not exist, then economic reasons suggest that the business is not viable and that there is no reasonable prospect. We didn't start this conversation with the view of debating some of the bigger issues in that regard, so I'm a bit cautious about that. But I do want to say that fundamentally the question needs to be asked whether we have a business.
Okay, great.
And that's it.
All right, lovely. So another really important question that has come up is from Bonnie Mkuno, who says, what advice can you give to businesses who have been doing well for many years, but who have been hugely affected by COVID-19?
Perfect.
22% decline in revenue.
Yes.
What approaches would you take into consideration in trying to budget for a new financial year? Lovely, practical question. Thanks, Bonnie.
Absolutely practical question. And that's the kind of question that I think is most valuable today. So, in fact, I think what is useful is to take a lesson from startups, because our world has changed. So when you've seen a drop of 22% of revenue, let me use one of my clients where they've seen a drop of 40% of revenue. And what they did was they said, okay, let's now assume that that's going to be our revenue level for the next 12 months. Now we have to go to our income statement and look at all of our costs. And we have to trim costs wherever we can. We have to get rid of expensive entertainment allowances. We have to scale back on the niceties in the office. Maybe we have to scale back on the person who comes and looks after the plants in the office. And wherever we can, we have to do that stabilization. We have to do those actions quickly. So it's about, as sad as this sounds and as harsh as it sounds, you have to take a sharp knife to your costs, and you have to cut your costs, and you have to ask the question, if we're spending some money, is it preserving value or enhancing value? If it's not doing one of those things, two things, you should not spend the money. That's like the harsh reality. That then allows you perhaps to survive. So we sometimes talk about keeping the patient alive. It's like when a patient is at a car accident and is in the emergency room. You want to keep them breathing, their heart beating, and stop them bleeding. You've got to stop the bleeding. So you have to trim your costs to match your revenue base. That's the first step. You're on mute, Morris.
Sorry, I said, I know I'm disturbing you, so please forgive me. But whilst you are talking about this thing about keeping the patient alive, on the Q&A, there's some discussion taking place regarding points that really speak to that. And I just want to amplify those. A question from Tina Fenter, who says, at what point do you call it and say a turnaround is not feasible? And another one called Halima Daniel says, what role does liquidation and insolvency play in business turnaround, right? So I'm just thinking that this notion of keeping the patient alive really speaks to some of those questions.
Yes.
Do you want to just amplify that a little bit more, please, Keith?
Yes. So well, I want to do it in the context of the business that had been performing well, but seeing 22% loss.
Correct, yeah.
In that context, I say to those businesses, you've got to do everything you can to what I call lengthen your runway. Stay alive for as long as possible while the uncertainty of the future starts to reveal itself. Because we know we're coming out of lockdown tomorrow, partially. But truthfully, I don't know of anybody who can, with any form of certainty, start to suggest what that may look like in terms of trading activity for businesses that are going to go back to work on Monday. We're hopeful, but we can't be sure. So I would urge companies to be conservative and batten down the hatches. I mean, using all these cliches, but they unfortunately are so true at the moment. But at the same time, and if you cast your mind back to when I had my slide up, I said under the part where we talk about turnaround plan development, we have to look for new opportunities. So there we are, the new opportunities. So I had a board meeting yesterday, and with the board, I was very pleased with the management team because they brought it up, not me. They have done 3 scenarios. They've said our scenario, and they've had a 40% reduction in revenue. So they've said our worst case scenario is that we have a 40% reduction in revenue for the next 12 months. How do we trim our business to be able to service that? The midpoint scenario is our revenue is going to be reduced by 20%. And our best case scenario is that after 3 to 4 months, we'll be back at the other. But they've trimmed their business to the worst case scenario. Then they said, right, now we have to look at new opportunities. So we discussed where new opportunities may emerge, speculated, because all it is a guess at this stage. And they have got a workshop scheduled for next Wednesday for their management team to start brainstorming new opportunities. some guidance in how to think about that. We say, let's have a look at our existing products and services and ask, what new customers can we sell them to? First question. The second question that we ask is, let's look at our customers and see what new products we can sell them. That's the starting point. So that, if for this particular client, is going to be the starting point for their workshop next week. Those will factor in to their planning, and their planning is reviewed weekly, because the key here is to be agile. So we've heard the word agile over the last 4 or 5 years. Companies need to be agile. I think never before has it been more necessary than now. We need to explore something that looks like a good idea, see whether it's taking traction or not. If it's not taking traction, we have to end it quickly without spending a lot of money. Then we have to, and we used to need to keep those ideas coming. So those are the two things: is cut your costs, trim your business to the size of the revenue you've got so that you can keep going. But while you're going under those tough circumstances, start holding workshops and say, what opportunities exist? Where can we do more business and different business?
So maybe if for those that are wanting a little bit more of an academic flavor, I would encourage them to read some of David Teese's work on dynamic capabilities, which really talks to the two concepts of explore and exploit. So you're talking about exploit your existing capabilities, exploit your existing client base, exploit your existing resource base, but be very smart in how you're exploiting that. But at the same time, explore new opportunities. So you need to have this dynamic capability of being agile to be able to do the exploration and the exploitation at the same time. I'm mindful that we have about 8 minutes left before the end of this Flash Forum. I'd like you to perhaps address a question that Andrew Baker has just raised, which is about stakeholders, which really says, please describe and explain stakeholder engagement processes in finding solutions and developing the recovery plan. So how would you, as a turnaround specialist, encourage organizations to engage their stakeholders?
Okay, so when we do a turnaround, we typically have a person or a team who's allocated the responsibility of stakeholder management. And the first thing we do is we say, who are the stakeholders in this business's success? And there's some obvious ones. There's shareholders, there's employees, there's suppliers, there's customers. There might be the community in the area where the business operates. There may be environmental issues. The receiver of revenue and SARS is a stakeholder. Other regulators. So we generate a list of the people we identify as stakeholders. The question we ask is, say, who has an interest in the outcome of this business, if it's successful or not successful? And that's what we use as the guiding point. Then what we do with those stakeholders. Now, at the beginning of COVID-19, I wrote a little article which I put on LinkedIn called Leading Through a Crisis, COVID-19. And if you find the time and you want to read it, you'll see some of this in there. But essentially what we believe in doing is we communicate honestly with the stakeholders and transparently. So we share all information with them that is not confidential to other parties or compromise other people. But if it's pertinent information, we share it in a transparent way. We share it quickly, and we tell them what we're going to do. And if things don't work out, we tell them they haven't worked out, and we tell them what we're going to do to try and remedy it. Now, why do we do that? Was because, well, there's two things we think. The first thing is that as human beings, we prefer to have bad news than no news. So if you leave me with no information, I make up my own information. And I start to draw conclusions which may be absolutely inaccurate, may be absolutely unfounded, and in fact may not help us solve the problem. So I'd rather you have the real information in front of you. The next thing is I need to ask you as a stakeholder to support the plans we put forward. Now, how can I ask you to support plans if you don't have the information? So we believe that by sharing the information with the stakeholders, it allows them to make informed decisions. And we do it honestly, transparently, and quickly, and on an ongoing basis. Our rule is let's rather over communicate than under communicate. Where we find rumors emerging and speculation that is inaccurate, we don't tell people they're wrong. All we do is we present facts that show that the conclusion drawn may be inappropriate.
Keith, there's a request from Terry to please maybe provide them a link to your article on LinkedIn. I presume they just need to follow you on LinkedIn. They will then find the article. Would that be a useful way of doing it?
Yes, I think so. Probably the best. That's a short article on leading in a crisis. Yeah, if you look for me on LinkedIn, you'll find it.
Great. And then on the Q&A, and I'm just going to ask you just be short and sharp, please, Keith. They say, as a business rescue specialist, how do you handle the situation where the owners of the company are the biggest impediment to success?
Interesting. So sometimes when you're doing a turnaround, it is necessary to have courage. And particularly when it's in a business rescue matter. I can tell you that I've been involved in a couple of business rescues where we've had to be very firm. In one of them, we fired the CEO formally after a disciplinary hearing held in following the Labor Relations Act, and he was the single largest shareholder in the business, and we fired him. In another matter, we found, and this is not commonplace, to be honest, but we did find evidence of fraud, and we reported them to the Hawks. So you have to have some courage. So shareholders, you have to be strong with them. We have to stop them interfering. We have banned shareholders from coming to the premises where they were trying to interfere. But I think probably the most significant one was where we fired the CEO, who was the biggest shareholder, and we prevented him, we banned him from the premises. So sometimes you have to do that if they won't listen to reason. But we found that given a few firm words, most shareholders we have found will start to see sense.
Lovely. So as we conclude, in my experience in this period is maybe going back to some of the issues that Bonnie raised earlier, particularly around how do you budget and how do you plan, is that we normally talk about long-term planning being something between 5 to 10 years. And whereas in this period, actually, to me, it seems like long-term planning is anywhere between 6 to 12 months. And I'd like you maybe to kind of, over the next minute as we conclude, to reflect on how companies and leaders in business can think about planning in the short run as we reopen as part of our wrap up. Please, Keith.
Okay, so I think the planning that we could probably start to employ we might well draw on disciplines like design thinking, which is about rapid prototyping, experimentation, and quick turnaround. So you indulge in planning sprints, but be ready to change your plans quickly. Review them frequently. Make them an alive document. So your survival plan. So you have two plans. You have your survival plan, which is your baseline. And your survival plan, you must be absolutely rigorous about, and you do not waver from that, because that is going to keep you going while you're planning the other stuff. Then that you're rigorous about. The other stuff, you must become agile, rapid prototyping, rapid turnaround, done in a series of sprints.
Thanks, Keith. I think we've hit our 45-minute mark. I'd like to thank everyone for joining us and staying with us. I see a question here about the role of the board. I'm sure Keith and I will be very happy to come back to you and chat to you about the role of the board in a turnaround. But if I may, one last word, be helpful and not be problematic in this time. And thank you very much for joining us. Please join us again next week for more Flash Forums from GIBS, and enjoy the gradual unlock from May the 1st. See you on the road at 6:01 exactly. Thank you and goodbye.
Thank you.